Thing number two that you need to know is that there are call options and that there are put options. A call option gives you the right to buy a stock at a certain price, and we already talked about it on the previous slide. It is the strike price before the expiration. So let me give you a very specific example. Often you see a call notated something like this, okay? So this here is an AAPL call 280 April 17. So let's decipher this, and what does this mean? It means that you can buy Apple, the stock Apple, for $280 before April 17. Now, you have the right to do this, but not the obligation. Let's take a look at a chart and see if this makes sense. As I'm recording this right now, Apple is trading at $260. Maybe a little bit above, maybe a little bit below, but that's what I saw when I looked at the charts earlier, when I took this screenshot here. So again, this option, which says AAPL call 280 April 17th, means that we have the right to buy Apple for $280 before April 17th. So Apple is right now trading at $260. And you have the right to buy Apple for $280 if you would own this option. Is this making sense? Let me ask you, how much is this option worth if Apple is trading right now at $260 and you can buy Apple at $280? It doesn't make sense, because why would you have the option? You could buy Apple outright right now for $260, which is cheaper than the strike price that the option is giving you. So this means that the option right now is worth nothing because it is so-called out of the money. This option is only worth something if Apple moves above 280. As long as it stays below 280, this option is not worth anything. Let me give you another example. Here is a different strike price. So this is an option, an Apple call option for $240. The strike price is $240, and the date is April 17th. So this means that you have the right to buy Apple for $240 before April 17th, on or before April 17th. So this $240, when you have this option, when you own this option, you have the right to buy Apple for $240, and right now Apple is trading at $260. So, same question here. How much is this option worth? Well, again, you're allowed to buy the stock for $240, and right now it's trading at $260. So this means it is worth $20. This means this option is in the money. Don't worry about the in the money and out of the money. Just understand the principle. The strike price basically determines whether this option has any value or not. So it is worth $20. But here's the kicker. If we look at the price of this option right now, you will see that this option right now is trading at $22.30. So why is this trading for more than $20? Why is there a so-called premium in there? This is what option traders call the time value. And here is why there's a time value. Because it could be that Apple is moving even higher right now, right? So this is what traders are anticipating, because we have 10 days left where we are allowed to buy this stock, Apple, for $240. And you see, as this goes higher and higher, it will be worth more. So options always have some time value in there in addition to this real value. Is this making sense thus far? All right. If this is making sense thus far, click on like so that I know that you're with me. And if right now you're still a little bit confused and say, well, what's going on? This is the cool thing. As you know, there's a video on YouTube, so it lives on the YouTubes forever. So you can watch it again, because this is what I highly recommend. Anyhow, so this is the basic principle of a call option.